It's almost 11 a.m. in Singapore and Shanghai, 2 p.m. here in Sydney. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories.
In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data.
Yields on treasuries advancing across tenors after Fed Governor Christopher Wallace says there's no rush to cut rates as inflation remains a problem. The risks are piling up for Japan's currency, stocks and bonds as the nation's fiscal year draws to an end. Yen traders on watch as an intervention threat looms. Also ahead, Chinese stocks erase their gains for March. Earnings disappointments fueling concern that more of the policy-driven rally will unwind. And India and Korea are again left on the bench by the FTSE Russell, which says the two countries are not yet fit to play in its key government bond index. Avril.
Well, let's take a look at how Asia markets are faring today. We're seeing an interesting picture. It's really how assets or stocks, after a two-day climb, are hitting a wall. It's those Waller comments. Japan's stock benchmark, the Nikkei, which yesterday was the outperformer, has become the big drag on the APEC stock gauge. We're also seeing the yen holding fairly steady after yesterday hitting those 34-year lows. We're keeping an eye on China assets as some of the banks' balance sheets show us how the property crisis is starting to affect them via bad loan ratios. We have some of the developers, the more troubled ones, Wonka as well as Country Garden reporting later today. Sunak came in with a beat. We're seeing Chinese stocks, a bit of gains there. Offshore, onshore though, even though there's that gain towards the 720 level, it's still sitting above that despite the stronger than expected yuan fix today. It's really about these Fed speakers coming in hawkish. At the start of the week, we got comments from Bostic, and as we head into the end of the trading week, remember, many major markets will be closed tomorrow. We have Tokyo CPI with US PCE numbers. We're hearing from the Fed Governor, Christopher Waller, saying there's no rush to cut rates.
I see economic output and the labor market showing continued strength, while progress in reducing inflation has slowed. Because of these signs, I see no rush in taking the step of beginning to ease monetary policy.
Fed Governor Christopher Waller there laying out the reasons why he doesn't see a cut. But that's what we're seeing across Asia for now. Paul?
Yeah, Avril, a bit of a down day for the Nikkei. We're not really used to seeing that at the moment, but some pressure on the yen. What's the level for intervention here?
I think the line in the sand seems to be 152. That seems to be what markets traders believe. But let's recap also what we've seen on the Japanese currency. Somehow, after the BOJ hiked for the first time in 17 years, it sent the yen weaker. And in the past 2 days, it's been a pretty wild ride. We've seen how hawk coming in dovish, that sent a trigger to 152 on the dollar yen. And then the finance minister yesterday also coming in to put a lid on things. We didn't see signs of intervention in the New York session, but the BOJ summary of opinions actually show that the officials seem to be keeping things accommodative. They're advocating for a cautious approach, and that's what we're seeing on the yen, which is the underperformer in G10s this quarter. But if you take a look at the Nikkei, that's been the outperformer. Today, it's gone from yesterday being the boost for the APEC gauge because it was the last trading day before stocks went ex-dividend. Today, it's the other way around. It is the big drag on the APEC, and you wonder how much longer the Nikkei rally can keep going. How much of this is fundamentals? How much of this is FOMO? Paul?
All right, thanks so much for that, Avril. We're going to talk a little bit more about Japanese stocks with our next guest now. He says they've become his highest conviction tactical view. So let's bring in Ben Powell, Chief APAC Investment Strategist at BlackRock Investment Institute. So, Ben, seen a bit of a pullback in the Nikkei today, but if we look at the broad sweep of things, we have a chart on the Bloomberg that shows just how much the Nikkei has outperformed pretty much every other market by a really, really wide margin. So when you see a pullback like this, is this an opportunity to get in?
Hi, good morning. Great to be with you. Yes, we at the BlackRock Investment Institute, we've been overweight Japanese equities for a few quarters, actually, but we upped that conviction, taking our overweight even higher because we continue to believe that the combination of the, if you like, the macro story, the nominal GDP boom versus a decade or two of deflation will continue. And importantly, the BOJ is not derailing that, so the macro story continues. And then, of course, as well as that, we have the bottom-up corporate governance revolution, if you like, which I think we're going to continue to see more and more news flow on, be that buybacks, dividends, be that unwind of cross-holdings. So that combination, we think, is very constructive. We still think global investors don't have enough exposure, so we at BlackRock are overweight.
How about the yen, though? Because we're hovering around 34-year lows at the moment. We've got those usual sounds that we've come to expect from the Ministry of Finance and the FX currency chief about the risk of intervention. Where do you see intervention potentially happening, and how does that affect your case for Nikkei bullishness?
Yeah, so we would actually be exposed to Japanese equities on an unhedged basis. So clearly we have some sort of short-term, very exciting situation with the Ministry of Finance potentially continuing to verbally intervene, trying to create something of a line in the sand, I guess. On almost any measure, the yen looks like a very, very cheap currency. So over the 6 to 12-month horizon, which is how we think about our tactical asset allocation views, we think the yen can actually appreciate, meaning that global investors won't be kind of inconvenienced by a weak yen derailing their local equity market gains. So we think this is a different Japanese story. It's much more to do with Japan, meaning Japan, i.e. a Japan domestic economic renaissance, benefiting local companies, I guess, be those banks, consumption. It's not so much a weak yen helping the very excellent Japanese exporters. It's much more to do with Japan, meaning Japan, and actually a yen moderation or even a little bit of a strengthening shouldn't derail that more, how can I say, localized Japan view.
To what degree, though, is this also a strong dollar story? And with that in mind, how effective could you see any intervention being?
Yeah, I think you're right. So I think Waller's comments obviously are somewhat more hawkish, although importantly, it's still, I think, key to note, even Waller's comments are still talking about the pace of cuts. So there's no discussion really about are we going to cut or not. The answer to that seems to be yes, the Fed is going to cut. The debate is when and by how much. So I think, as we get to June, likely we start to see a cutting cycle, which should take some of the heat out of the dollar strength that we're definitely seeing right now. And again, that should be beneficial. Clearly, as we have the Fed beginning their cutting cycle, as the BOJ very, very carefully continue their very careful hiking cycle, that interest rate differential should narrow, meaning the yen should find some strength, not too much, but some strength in the months ahead.
Well, we're counting down to another important piece of data out of the US for the Fed. It is, of course, the PCE deflator. It's going to come out while the Asia Pacific's on holiday. What are you anticipating around that? Because we have seen a few surprises that we didn't expect, and expectations for easing from the Fed have gone from something like 7 cuts now down to 3. Do you think that maybe those expectations could end up getting tweaked again?
Investment Institute came 3 cuts was because we were very much expecting an inflation roller coaster. So the market has obviously come back much more in line with our view now, with only 3 cuts, approximately 3 cuts priced for the year. That makes sense because these, let's call them surprises, we don't find them that surprising. We think you're going to see more and more of this kind of inflation roller coaster, uncertainty and volatility. That's going to continue to create a different macroeconomic regime, a less certain one, more volatile markets. So we think this is going to continue. Critically, what's been, I think, very important for for markets is the Fed's relative comfort with this over the last couple of months. I mean, inflation has surprised to the upside, and yet Powell and other senior Fed members have been broadly okay with this. So it seems like we're getting something of a goalpost glide where the Fed is implicitly accepting inflation can be okay at, let's say, a range of 2 to 3%, rather than a kind of very clear we must get to 2% at any cost. So this goalpost glide, I think, has been maybe the most important thing in financial markets over the last month or two, as the Fed has tolerated even slightly surprisingly higher inflation prints for the last couple of months.
Just before, I just want to get back to Japan briefly before we move on. We do have an enormous balance sheet for the Bank of Japan. It's going to need to exit the ETF market as well. What's your risk scenario around those two things?
So I think the Bank of Japan is extremely conscious of this risk, and I think they have gone extremely out of their way appropriately to manage this risk. And this is why the BOJ has been, to my ears at least, so clear that they're going to be very, very slow, very marginal, give the market extreme guidance about what's going to happen so as not to take anyone by surprise. So I think the interest rate risk obviously is there. There's a lot of debt. If interest rates went up a bit quick, for sure it would be inconvenient. But I think it's important we all recognize the BOJ fully understands that and is doing everything they can to mitigate that risk. And I think they have got the firepower. Yes, they kind of abandoned yield curve control last week, but they said very clearly if they need to bring it back, they can and they will.
All right, Ben Powell of BlackRock Investment Institute is going to be sticking around. We're going to be talking about China in just a moment. And also coming up, an outlook on the Indian markets with Standard Chartered Bank. We're going to discuss why they expect volatility in the rupee to increase, but with gains only in the longer term. First, though, President Xi Jinping meeting with US business chiefs and urging them to invest in Beijing. We'll be live at the Boao Forum next. This is Bloomberg.
The respective successes of China and the U.S. are opportunities for each other. As long as both sides regard each other as partners, respect each other, live in peace, and cooperate for win-win results, China-U.S. relations will become better.
There's Chinese President Xi Jinping making his pitch for foreign investment in China directly to a group of US CEOs. He met with executives in Beijing, including Blackstone's Stephen Schwarzman and Qualcomm's Cristiano Amon. So let's get the details now from Bloomberg's chief North Asia correspondent, Stephen Engel. He's there in Boao. Steve, what are your takeaways from Xi's comments at this meeting?
Well, I think the fact that he met with U.S. business leaders who stayed on an extra day or two after the China Development Forum is a good sign. He was congenial and cordial. He was engaging from the people that I've spoken to who were there at the meeting, or at least the messages I've gotten from those who were at the meeting. And it's a good step, obviously. There's a lot of concerns by U.S. business people and academia who participated in that meeting in the Great Hall of the People that lasted about an hour and a half. The concerns, obviously, is about policy opacity, and they want more clarity. The arrests of some Americans, according to the U.S. Ambassador Nicholas Burns, who told me that a couple of weeks ago, the raids on consultancies, and the overall climate, obviously, in what is increasingly becoming a bifurcated world in technology and geopolitically. So the fact that Xi Jinping was open, smiling, engaging, saying that they're open for business and welcome foreign participation in this economy is a good first step. There will still be some of that skepticism, but that's a healthy thing. And that's also something that we're seeing here at the Boao Forum.
You're also at the Boao Forum. You've been hearing from the head of China's legislature, that is Zhao Lijia. What's he been saying? He's really been echoing Xi's remarks to a great degree.
Well, I think anybody in power right now, especially among the 7-member standing committee, and he's number 3. He is the chairman of the standing committee of the National People's Congress. He is number 3 after Xi, after Li Qiang, and then it is Zhang. He is going to comment along the same lines. They are reading from the same script, no doubt. However, what struck me about the speech, and I did not hear it, so I could not detect the tone, but from the headlines that we got just in the Boao Hall, main hall nearby here, his tone was a bit strident at the top, essentially talking about some of the geopolitical issues, but he brought Asia into the fold. He wasn't saying from China's perspective, he was talking about Asia's perspective. Keep in mind, this is the Boao Forum for Asia, so they oftentimes couch their statements in that context. He said bullying acts are deeply harmful. He says China believes all countries are equal regardless of size. China is ready to intensify cooperation with all countries on technology. And again, he said we must prevent Asia from becoming an arena of conflicts.
All right. Chief North Asia correspondent Stephen Engel there at the Boao Forum. Let's get a little bit more on the outlook for China with Ben Powell, Chief APAC Investment Strategist at BlackRock Investment Institute. Ben, thanks so much for staying with us. And I just want to return to some of those remarks that Steve was making. Zhao and Xi Jinping both saying and both really courting foreign investment. But does China really offer the transparency, the regulatory clarity, the consistency that foreign investors are looking for?
It's a fascinating time in Chinese markets, that's for sure. The headwinds continue, demographics, geopolitics, property, but the tailwinds are there as well. So it's worth remembering the scale of this economy. Roughly, China is a $17.5 trillion GDP economy. So if China grows by maybe 6%, 6.5% nominal this year, that's around $1.2 trillion, which standalone would be a G20 economy. So for sure there are headwinds. Those are ongoing and presenting significant challenges, particularly for Western investors. I think that's clear. That's not changed. But what has also not changed is the growth of the economy, the growth of the middle class, the consumption story that we've all been talking about for a long time. That's still there. So I think China's a great example of where, as investors, of course, we need to be careful, very selective, but there can be opportunities within this mix.
Yeah, I mean, we can't forget that it is the world's second largest economy, as you say, and still a very compelling growth story as well. But how do you strike that balance? Where do you see opportunities in China at the moment?
We strike it very carefully. So I think property continues to be the elephant in the room, but it's important to note it is a slightly smaller elephant. Markets are extremely aware of this as an issue, obviously, and the ripple-through effect. That doesn't mean it's unimportant. Again, it's an elephant, but is somewhat better discounted. What's going to be key going forward, I think, is a revival of animal spirits that we have not seen yet. So not so much the global investors, it's the local investors and local consumers which are key. Just to remind everyone, China is still predominantly a retail market. Around 70% of equity turnover in Chinese mainland equity markets is local people, is retail investors. So it's their confidence that is key to a sort of sustained recovery in markets. And frankly, we just haven't seen that. So we need to see maybe a little bit more stimulus forthcoming to galvanize domestic confidence. And then maybe we as global investors can kind of piggyback onto that. But so far, that has not happened.
Just want to get your view on the debt market in not just China, but also Asia more broadly, because fund managers, including some of your colleagues, have resumed rate cutting trade by boosting exposure to shorter debt. But if we take a look at the market in Asia, these longer dated notes are doing better than the notes dated 3 to 5 years. So can you explain the disconnect?
Yeah, so look, we've actually got a preference for emerging market hard currency, dollar denominated, I guess expressing something of a dollar view, not too much. It's more just to do with the yields, which are, by global standards, very, very attractive. Clearly, we're all kind of waiting for the starter gun to fire. We're assuming June for the Fed to cut. I think a lot of emerging market central banks, including in our part of the world here in Asia, are almost waiting for Big Brother to give permission, and then we can see more of an easing cycle spread. But I think naturally, many central banks all over the world are waiting for that starter gun, potentially June, let's see, and then we can see more enthusiasm, more momentum as the disinflation dynamics play through, and we can benefit from that in these markets.
All right, Ben Powell of BlackRock Investment Institute, thanks so much for your time today. We do have plenty more ahead. This is Bloomberg. Basel Hong Kong officially opens its doors to the public today, putting the strength of the Chinese consumer to the test and painting a picture of demand in the art market for 2024. Bloomberg's Lauren Lau gives us a preview.
Art Basel's back, but are the buyers? Exhibitors who've set up shop for the 5-day-long fair hope so. Numbers of galleries showcasing work are up by a third from 2023, matching the fair's pre-pandemic scale.
We're 242 galleries this year. We're up 37% year on year. We're seeing international audiences once again back in Hong Kong from all over the world, especially in Asia. There have been a number of pre-sales already, which is always exciting.
According to UBS, global art sales in 2023 eased after 2 years of growth, slipping by 4% to around $65 billion. But in China, so far the appetite for luxury art has held up. It's now the second largest art market globally after the US, and the only major market to show an uptick in value over the course of 2023.
The economy is clearly softened in mainland China, so there's no mistaking that. There's also opportunities, we feel, to bring activity and to centralize and congregate that activity at moments like Art Basel.
But it's more than just art for Hong Kong. The city's navigating a consumption and tourism slump, with hopes that so-called mega events like Art Basel will revive retail spending.
The art market community is clearly invested here, and we are as well. And I think collectively, we'll see the benefits of that this week and in the future.
All right, that's Bloomberg's Lauren Lau in Hong Kong there. Let's take a look at how we're tracking on markets. We're particularly watching banks in China at the moment. ICBC, BOCOM, Agricultural Bank of China and CCB are among those that we're going to be hearing from today. Of course, China's long-running property downturn has not been doing banks too many favors. We did hear of Bank of Communications yesterday. That saw its bad loan ratio jumping to almost 5% at the end of last year. ICBC saw a similar issue according to its Wednesday filing. So we're going to be hearing from those banks later. China Vanke also among those that we're going to be hearing from. We're not expecting great things there either. We're expecting to see full-year profits slide, perhaps by as much as 20%. Contracted sales dropped 43% in the first 2 months of 2024, and that was dragged down by lower exposure to low-tier and some of those weaker Tier 2 cities. Country Garden, another one of those troubled property developers that we're going to be hearing from today. That notwithstanding, we are seeing the China market performing pretty well at the moment. CSI 300, one of the bright spots in the Asia-Pacific at the moment, heading to the lunch break. Better by 1.2%. The Shanghai Composite up by 1.2%. Hong Kong stocks also performing pretty well, up by almost 1.4%. We'll take a closer look at markets in a moment. There is plenty more ahead. This is Bloomberg. All right, welcome back. As I mentioned, we do have China markets just heading to lunch, but heading to lunch in a pretty good mood. We're seeing a fair bit of positivity for the markets in China. CSI 300 better by about 1.1% right now. Same story for the Shanghai Composite. Stocks in Hong Kong also better by 1.3%. We are keeping an eye out for the offshore yuan HIBOR, because yesterday we saw that hit highs that we haven't seen since April 2022, 5.98%. We also had the fix a little bit earlier. That was 7.0946 for the US dollar offshore yuan reference rates. So there you see. Markets performing pretty strongly. 7.2255 for the offshore yuan, I beg your pardon. All right, let's take a look at how we're doing on markets in Japan. Not so good today. Avril Hong's in Singapore going to explain why. Might have something to do with the yen, Avril.
A lot to do with the yen, but I think it's also bad timing. Yesterday, we saw the Nikkei, the outperformer. It was leading the charge in the Asia Pacific. Today, it's turned into the underperformer, the laggard, down 1+% for the morning session, and more of that loss coming through as we start the afternoon. And we're seeing this because there was the last trading day before companies go ex-dividend yesterday. So today, there's a bit of that unwinding. But overall, the cheap yen, you're correct to say, has been helping things. Let's flip the board, take a look at what's going on across assets in Japan. There are risks. We have Tokyo CPI that is due tomorrow, and it's coming out on a day where many major markets will be on break and tight liquidity is expected. We're also approaching the end of the fiscal year. So those are some of the things we will be watching out for. Japanese stocks down today. The yen pulling away from 152 yesterday. That was the 34-year low. We're seeing bonds holding fairly steady. Paul.
All right. Thanks very much, Avril. Let's dig a little bit deeper into that yen story and the flashing signals for intervention with our MLive managing editor, Mark Cudmore, in Singapore. So, Mark, we have been hearing quite a bit of jawboning today from the Ministry of Finance, also Japan's top currency diplomat. What have we been hearing from them?
Well, we've been hearing increased rhetoric over the recent days as we did reach that new 34-year high in dollar yen. I think everyone's kind of wondering what will be the trigger for intervention. We do know that it's not just level, it is pace of move. There's a little bit of concern with the massive option barriers out there at 152, that if that level is taken out, well, then we might see a very rapid move up to 153, 154 level, and that then kind of rapid move might be the catalyst for intervention. And you could probably see that being a potential risk going into the kind of low liquidity kind of long weekend in much of the world, taken to late on the Thursday session when US markets are going to be closing. There's a chance that we might get that risk then. So that's why markets are on edge about intervention. Overall, though, I'm not convinced by the whole intervention story, apart from this kind of rapid move that we might get on that break of 152. The fundamentals for a weaker yen still remain very, very strong. And I think if we do get intervention, people will enthusiastically buy the dip in dollar yen.
Yeah, it's an interesting point you make, and we raised this with our last guest as well, because it's one thing to target a weak yen, but on the other side of that, there is a mighty US dollar. Is there anything that intervention could effectively do?
Not much beyond the short term. I think that until you get a world of lower US yields, dollar yen is not going to turn around. The BOJ rates are not entirely irrelevant, but they're pretty much irrelevant in terms that there's just such a marginal impact. And in a world where I think it's going to be a struggle for the Fed to cut rates as aggressively as Powell is still trying to commit to, I think, I know Powell is still saying there's going to be 3 rate cuts this year from the Fed. That's really the maximum. I think that's pretty unlikely we'll get that many cuts ultimately in the end. And so I think the only risk from the US yield perspective is to the top side, unless we get a material change in the US economy, which means there's going to still be upward pressure in dollar yen. But it's not just in dollar yen. If you think on the cross basis, the yen is still just stands out as exceptionally appealing as a funding currency given its deeply negative real yields.
We also had the Bank of Japan summary of opinions today from that meeting just passed, where we saw the end of negative rates. But one of the members of the Bank of Japan board said, look, whatever you do, don't misinterpret the end of negative rates with tightening. So is some of the Bank of Japan rhetoric kind of adding to this weekend case?
Well, I mean, I think that's very, it's very valid to kind of highlight that, because they've kept up their, their persistent easing policy. They continue to kind of, it is still extraordinarily easy policy, and they've been very clear to make that. I think, though, that the Bank of Japan will be encouraged by the fact that they did remove negative rates. It didn't cause a shock in markets. And in fact, we're not even seeing the yen appreciate since that meeting. And therefore, I think that ultimately, the fact that we probably will continue to see depreciation pressure on the yen over the coming months means that we might get more BOJ tightening this year than the markets are currently pricing. Simon Flint, a colleague on our team, has done a really exceptional analysis this week, kind of doing a revised Taylor rule analysis, saying if you assume gradual policy and you take inflation expectations into account, then we probably might get as much as 70 basis points, 60, 70 basis points of hikes later on this year from Bank of Japan, which is kind of double what the market is pricing. And I think that's an interesting framework to look at it, because I think we might start thinking that way, and Bank of Japan might start thinking that way if the yen continues to be under depreciation pressure, which I expect it will be.
Well, we're seeing a bit of weakness for Japanese equities at the moment. Is that a function of what we're seeing with the yen, or is there other stuff going on as well? Because there are quite a few stocks trading ex-dividend today.
Yeah, I think it's the ex-dividend story, bit of profit taking. That's the catalyst here. I don't expect that Japanese stock weakness to sustain. The two big drivers for Japanese stocks very clearly are what's happening in US stock markets and what's happening in the yen. And I think that the macro backdrop for global stocks, but US stocks in particular, is exceptionally strong. We've got a Fed which is sending a very dovish message despite the fact that growth is still strong. They're saying they're desperate to cut even though there's no economic justification for cutting right now. And that's an extremely strong tailwind for stocks. So for US stocks primarily, but global stocks. So risk sentiment's going to stay positive, and that will drive US stocks higher even though valuations seem quite stretched at the moment. And that and the combination of those higher yields and the pressure on the yen means that ultimately Japanese stocks can keep on doing well. They've been massive outperformers this year. It's a little bit of profit taking ex-dividend. I wouldn't read too much into the short-term price action.
All right, Markets Live Managing Editor Mark Cudmore there. Thanks so much for joining us. Still to come, our interview with Standard Chartered Bank's India Financial Markets head. We're going to discuss their outlook for Indian government. Welcome back to Bloomberg Markets Asia. You're watching the India focus. We've got FTSE Russell holding off on adding India to its emerging market bond index, while noting progress in the accessibility of the market. FTSE says it still isn't satisfied about certain other criteria. For more on this, let's bring in our EM Asia FX and rates reporter, Malavika Kormakol in Mumbai. So, Malavika, what are FTSE's lingering concerns here?
Yeah, hi Paul, good morning. I think they're all concerns around market access. So they flagged things like foreign investor registration, things like tax clearance process. But I do have to point out here that India was being considered for a much smaller index. The bigger index inclusion, which is the JP Morgan inclusion, is still supposed to happen starting June this year. So bonds have already rallied today because they have looked through the FTSE miss, because they're now focusing on the lower borrowing plan, which came out last night.
So the Indian government's also announced their first half borrowing plan. That didn't quite come in with expectations either. Tell us more about that.
Sure, yeah. I mean, it came lower than expectations, and lower borrowing plans are always a good news for the bond market, like we saw the rally in bonds today morning when markets opened. It is especially important given a year where we're going to have increased demand from foreigners, given the index inclusion, like I had pointed out earlier. There is also a 15-year bond, which is a new bond, which was introduced last night. So it's all pointing to the evolving nature of the Indian bond market, where most space is being made for newer demand from insurers, from pension funds, from even foreign investors who are coming in for the bond index inclusion.
All right, that's EM Asia FX and rates reporter Malavika Kormakol there in Mumbai. So for more on her outlook with India, we're joined now by Parul Mittal Sinha, Head of Financial Markets India and Head of Macro Trading for South Asia at Standard Chartered Bank. Parul, thanks so much for joining us. I just want to pick up on that point that Malavika was making about government borrowing. 7.5 trillion rupees, that was about $1 trillion less than the market was expecting. What's your take on that?
Hi, Paul. Thanks for having me. So yes, it was a positive surprise for the market yesterday, where the H1 borrowing was less than the previous year's first half borrowing. by 15%. Market was expecting lower by around 5 to 7%. So that's a definite positive surprise. Even looking at the composition of borrowing plan, the weights of the longer end bonds versus the lower end bonds, that's broadly in line with how it was the previous year. Slight increase in the weight of in the notional amount of borrowing, which will happen in the 15-year and longer bonds. But that's in line with the excess demand or increase in demand we see from insurance and pension sector investors in India, where their demand is growing at a good clip of 10 to 12%. So good cheer for the markets, and this comes on the back of.
Yeah, there's plenty of demand, that's for sure. I think there's 10 billion of inflows into government bonds since JP Morgan announced the inclusion of India in its emerging market bond index. So is this a trend that you expect to see continuing?
Yes, absolutely. So ever since the inclusion in JP Morgan bond index was announced last year in September, we've seen a steady inflow of $1.5 to $2 billion from foreign investors into the Indian market. Around $10 billion has already come in. On top of this, there has been almost a $4 billion of investments in the rupee-denominated, dollar-settled supranational and agency bonds. So that's also additional demand, which has not hit the Indian market, but definitely represents the increased interest in the India exposure. From here on, if I look at how the demand supply is panning out, how we are at the peak of the interest rate cycle in India and also globally, the positive sentiment of investors towards India remains intact. We think this flow of money will continue. The bulk of these investors are really fast money investors and some of the real money names who have been familiar with the India story, who are familiar with the India markets. We think there's a large chunk of investors who will be new to India, who will be followers of the index, who will come in as the index weight starts increasing in June. We are expecting anywhere from $25 to $30 billion of additional inflows to come in, and the Indian markets are definitely very excited for that.
Yeah, I want to talk about RBI policy in a moment, also the direction of the rupee. But in terms of all this enthusiasm, this investment that's coming into India at the moment, how is Standard Chartered approaching this? What's your strategy?
So India is a core market for SCB. We have very strong domestic presence across the entire product suite. So we are looking forward to helping our clients along the entire inclusion way, familiarize them with the Indian markets, the various access routes they have. So we've been onboarding a lot of new names. We've seen interest in instruments like total return swaps, the TRSs, in NDOIS, in NDS, the derivative instruments that give clients exposure to India. We are looking forward to helping them do the FX conversion, hedging of their investments in India. We are uniquely placed to enable and facilitate our clients and give them access to the India markets. We are one of the largest international banks present in India, and we have a full product suite available. So we are working very closely with our client base.
Just as you were speaking there, we were seeing a chart of the RBI's current rate. How is the market and how are you positioned for the RBI policy decision next week? Is there anything specific that you're looking out for, anything that you're listening for?
The RBI policy next week, we are not expecting any changes on the repo rate front. So they will continue to remain on hold on the repo rate, which is at 6.5%. What market and us will look out for is how their commentary on liquidity evolves. So in the last policy, they went from being hawkish or keeping the liquidity stance in the market from a deficit mode to a more neutral mode. We think they just continue on the same. Another point that market participants will look out for is their commentary on stance. So RBI have maintained their stance as withdrawal of liquidity. Whether they change it to a neutral stance from withdrawal of liquidity, that will be a big market mover if that comes. Currently, market is giving something like a 15 to 20% chance of something like that happening. So that is something which will be exciting if it comes through. In terms of rate cut expectations, market is not pricing in any rate cut, repo rate cut over the next 10 to 12 months. What we think is RBI will follow the Fed cycle. Only if Fed delivers a rate cut will RBI follow. Otherwise, given the growth dynamics, RBI is not going to go ahead and deliver a rate cut.
Parul, I just want to quickly get your thoughts on the rupee as well, because we saw some sharp movements last week. Do you take this as a sign that the RBI is prepared to be a bit more amenable to allowing some volatility in the currency?
Absolutely, Paul. So last week, dollar rupee moved it had been trading with the wall level of less than 2%. And we saw a 1% move higher in dollar rupee in 3 days. So that set a lot of excitement in the market with clients looking at hedging. A lot of long rupee positions had built in ahead of this index inclusion, and the way rupee had been behaving very nicely. We saw some stops also go through. What it does tell us is that RBI's tolerance for a bit more volatility in rupee has embarked. We think this continues. What we're looking out for is whether this tolerance is more towards rupee weakening than letting rupee appreciate. They have continued to amass reserves. Their reserves now stand at $650 billion. We think that may continue. So yeah, stable dollar rupee is the way to go. We don't expect it rupee to appreciate materially, but yes, definitely more volatility in dollar rupee.
All right, Parul Mittal of Standard Chartered Bank, thanks so much for joining us. And let's check those Indian markets, how we're tracking there. We're watching particularly closely ICICI Securities and Bank. It's well, it was showing a little bit of weakness a bit earlier, but of course the brokerage arm, ICICI Securities, getting 71.8% of public shareholder votes in favour of delisting those shares. This is according to an exchange filing. So we're seeing shares for ICICI Securities slipping by about 3.5%. ICICI Bank, though, is performing reasonably well, better by about 0.6%. All right, still to come. Smartphone giant Xiaomi unveiling its first electric vehicle, charging into unfamiliar and very competitive market space. Details on that next. This is Bloomberg. All right, welcome back. Let's take a look at Chinese EV stocks now, including Xiaomi. Now, the smartphone giant is debuting its first electric car today in China's crowded and cutthroat market. So it's going to start selling the SU7 series up against some very intense price cuts from existing players such as BYD, Tesla, XPeng and others. The launch is also a key test for Xiaomi's stock. That's seen an $8 billion rally on the back of its EV foray. So let's just take a look at how some of these stocks are doing at the moment. There you have Xiaomi at the top there, better by about 3%. So the market's liking this news. But all the EV players in China performing pretty well at the moment. That's notwithstanding that very, very competitive market. And our Bloomberg opinion columnist David Fickling says despite the gloom around China's EV market, is clearly showing the rest of the world that the future of the auto industry is very much electric. So, David, can you walk us through your argument that electric vehicles on the brink of victory in China?
Yeah, sure. I mean, it's pretty simple, really. 40% of the cost of an electric vehicle is the battery, and 40% of the battery cost is raw materials, so your nickel, your lithium, and your cobalt. And we saw in recent years surging prices for those raw materials, and they've absolutely plummeted over the past 12 months, and that's bringing the price down everywhere. These vehicles were on the verge of undercutting for purchase prices, internal combustion engine vehicles run on gasoline and diesel. But these falls in battery prices are pushing them distinctly underneath, and they're distinctly cheaper now. We've seen this dramatic array of cost cutting over the past 12 months in China. There was some expectation that we'd see a bit of a pause of that, but this is March is peak season for the car market in China, and those price cutting is coming back again. We saw BYD's results yesterday, and they're actually looking pretty solid. So there's room for further price cutting. This market has more competition, and crucially, the big losers are going to be the internal combustion engines. They've cut as as low as they can really, and they can't cut any further. But there's still room to go for the EVs.
Still some variables here, though. I mean, are those input costs for batteries likely to remain depressed? And also, is the Chinese consumer really confident enough to start buying?
Sure thing. I mean, in terms of the raw materials costs, certainly if you talk to the miners, they are not seeing, not seeing surging prices anytime soon. You're seeing, for instance, nickel miners is the classic one. Roughly half of the nickel industry is running at a loss at the moment, and you talk to people like BHP and Glencore, who've been have a lot of nickel production that's sort of overprices, and they're not really seeing that coming back anytime soon. In terms of the market, these are the cars that people are buying. BYD was saying this week that they expect NEVs to be over 50% of the market this year. And actually this month, according to the China Passenger Car Association, we're already at about 45.5% market share. So we're very close to half the market. And this is before some of these real big cost cuts come through.
Are these the cars people are buying outside of China, though? Because I know that you'd never see a BYD on the streets here in Sydney a few years ago, but now...
They're starting to come in here. Of course, here in Australia, we're in a market that has zero tariffs for imported vehicles. So that's quite different to somewhere like the US or Europe. Certainly in Europe, some of them are turning up. Supposedly about a quarter of the EVs in Europe this year sold will be Chinese-made. They're pretty rare in the US. You have a 27.5% tariff on the cars there. And there's also a great deal of trade tension between the US and China, and between EU and China as well. But it's sharpest on the US front.
All right, Bloomberg opinion columnist David Fickling covers energy and commodities for us. Thanks so much for joining us. Okay, let's take a look at how we're doing on markets, particularly focus on some of these Asian chip names. We've got Hanmi Semiconductor doing extremely well, up by about 17% at the moment. Honhai also having a good day. TSMC, though, a little bit of weakness there. SK Hynix also just looking kind of flat, but Hanmi has a very good story to tell the market at the moment. We are, of course, on the brink of a public holiday here in the Asia Pacific. So let's take a look at what markets are going to be closed over the next few days. Here in Australia, there's not going to be any trade this coming Friday. It is, of course, the Good Friday break. New Zealand's also going to be shut. Hong Kong, India, Singapore, Indonesia, Philippines also out. And the holiday rolls on Monday for New Zealand, Australia and Hong Kong. And on Tuesday, there'll be no trade in China, Hong Kong or Taiwan. All right, that is it from Bloomberg Markets Asia. Stay with us, though. Daybreak Middle East and Africa coming up next. This is Bloomberg.